Have you ever looked at your ridiculously low mortgage rates and just felt trapped? You love that rate, but you really need a new house. Well, what if you could just take your mortgage with you? It's this huge idea called a portable mortgage. And in this explainer, we're going to unpack exactly what it is, why it's so incredibly complicated, and what it could mean for the entire housing market. All right, so here's what we're going to cover. First, we'll talk about the problems so many homeowners are facing right now. We're calling it the golden handcuffs. Then we'll dive into the big idea of a mortgage that actually moves. After that, we'll hit the massive billion-dollar obstacles standing in the way. We'll explore who wins and who loses, and then wrap up with some real-world options you can actually use today. Okay, let's get into it. So first up, let's really define the problem. I mean, in a way, it's a good problem to have, but it's got the whole housing market in this strange kind of stalemate. It's that feeling of being trapped by a great rate. I mean, this is the question on millions of homeowners' minds, right? You bought or refinanced during the pandemic, and you locked in a rate that honestly feels like winning the lottery today. But now, life happens. Maybe your family's growing, you got a new job, and you're stuck because giving up that rate just feels financially impossible. And this is not some small niche problem. This number is absolutely staggering. Realtor.com says a full 80% of U.S. mortgage holders have an interest rate under 6%. This has created what economists are calling the lock-in effect, and it's basically freezing housing inventory and keeping people from making the moves they really want and need to make. So, with the market basically frozen solid, a pretty radical idea is starting to gain some serious traction as a way to thaw things out. Let's get into section 2, the whole concept of a mortgage that can actually move with you. And listen, this isn't just some fantasy cooked up on the internet. The Federal Housing Finance Agency, that's the FHFA, the people who oversee giants like Fannie Mae and Freddie Mac, they've actually said that they are actively evaluating the idea. So yeah, this is being talked about at the highest levels.
So what are we even talking about here?
Well, a portable mortgage is pretty much exactly what it sounds like. It's a loan that would let you sell your current home and then transfer your existing mortgage with its amazing low rate and all its terms over to the next house you buy. Now, it is absolutely crucial not to get this confused with another term you might hear, which is an assumable mortgage. They sound similar, but they're basically opposites. With a portable mortgage, you, the seller, take your loan with you to a new house. With an assumable mortgage, the buyer takes over your loan on the house you're selling. Totally different things. Okay, this all sounds pretty incredible, doesn't it? Like a simple, elegant fix to unfreeze the entire market. But, as we're about to see, there's a massive, multi-trillion-dollar reason why this is not so simple at all. And you've got to ask, right? If this could help so many people, why isn't it already a thing? I mean, it's pretty common in places like Canada and the UK. What makes the United States so different? Well, the answer really comes down to 3 letters, MBS, mortgage-backed securities. You can think of this as the gigantic financial engine that powers the entire U.S. housing market. Basically, lenders take thousands of individual home loans, bundle them all together, and then sell little pieces of that bundle to investors. Doing this gives the lenders fresh cash to go out and make new loans. And here is the absolute heart of the problem. The entire MBS system, this whole engine, is built on the fact that each mortgage is legally tied to a specific physical property. That house is the collateral. Investors know exactly what asset is backing their investment. A portable mortgage completely shatters that link. If the loan can just up and move to a different house, the collateral changes, and suddenly the risk for investors becomes a giant, messy question mark. And the experts are being very, very clear about how risky this could be. Just listen to this from Jake Krimmel, a senior economist over at Realtor.com. He says that widespread implementation would have, quote, unintended consequences, many of them worse than the issue they're trying to solve. Wow, that is a serious, serious warning. But hey, let's just imagine for a second that we could wave a magic wand and solve all those technical problems. What would the fallout actually look like in the real world? Who would win? And more importantly, who would lose? Because let's be real, you can't just change the fundamental rules of the game like this without creating a brand new set of winners and losers. And with portable mortgages, that divide could become very clear very fast. That same economist, Jake Krimmel, puts it bluntly. He says it would create a world of haves and have-nots. The haves would be anyone holding what he calls the golden ticket, that pandemic-era mortgage, and it would give them a massive, massive advantage. So let's get specific. The winners?
They're pretty obvious. It's all the current homeowners with those sub 4% rates. It's the families who are desperate to upsize but feel completely trapped. All of a sudden, they'd have the freedom to move and bring their single biggest financial advantage right along with them.
But, and this is a huge but, the list of potential losers is much longer and, frankly, a lot more concerning. First-time homebuyers and renters, they'd be at a huge disadvantage, trying to compete against buyers with this supercharged financing. And all this new demand could push home prices even higher for everybody. You could end up creating a deeply unfair two-tiered market. Okay, so if a truly portable mortgage system is a super complex solution that's probably a long way off, what can you actually do right now? In our last section, let's look at some practical, real-world alternatives that exist today. For any homeowner who feels stuck, there are really three main paths to think about right now. One, you can tap your home equity. Two, you can look into a government-backed loan for your next purchase. Or three, you can try to hunt down a seller who has an assumable mortgage. That first option, tapping your equity, is powerful because of numbers like this one. According to a recent bank rate analysis, the average U.S. homebuyer has gained over $112,000 in home equity just since 2020. That is a huge asset you could potentially use for a down payment on a new place or even to fund an addition to your current home. Your second option is to explore government-backed loans for that next home purchase. We're talking about things like VA loans for veterans, USDA loans for certain rural and suburban areas, and FHA loans, which are open to pretty much everyone. These often have more competitive interest rates than you'd find with a conventional loan. But here's the final, crucial takeaway. When you step back and look at everything, the dream of a portable mortgage and all the real-world options we just talked about, they all have one thing in common. They are all credit solutions. They focus on the demand side of the housing equation by making it easier for people to borrow money, but they do nothing to solve the core issue. And that leaves us with this one giant, lingering question. After all this debate about interest rates and new kinds of financing, are we just trying to solve a credit problem when what we really have is a supply problem? Because until we actually build more homes, any solution that just boosts demand risks making housing even less affordable for everyone else. And that is a thought worth sitting with.